Concerns over the worsening debt crisis in Greece, Spain and Italy have sparked losses for shares across Europe and the United States, and owing to this, investors have moved away from equities to safe haven investments that include cash and US and German government bonds. Now, this move has driven the yield on 10-year US Treasury bonds to a record low of 1.6%, which is the lowest it's seen in nearly 60 years. The yield on German government 10-year bonds also fell to 1.2%, with yields on the 2-year bond dropping to the zero level. Meanwhile, the indicative cost of borrowing for Spain has soared as investors worry about its deficit concerns. Also, concerns over Spain's financial situation has driven up the yield on the government's 10-year bond to 6.7%. The banking crisis in Spain has already pushed the country's borrowing costs closer to the 7% danger mark. Now, if Madrid's bond yields cross the 7% threshold, it may be forced to seek an international bailout. All right, but let's get a perspective on the outlook for the Eurozone and the financial markets there. We are joined now on the show by Josh Raymond, who's a market strategist at City Index. He joins us on the show from London. Josh, to begin with, May has turned out to be the worst month this year for global equities, staying true to the maxim sell in May and go away. But with the outlook for Europe remaining as bleak as ever, do you think things could be as bad in the months ahead as well?
Well, I think historically, I mean, you don't just look at May, you also look at the period from May, June, July, all the way through to August. And the reason why, obviously, is you get a number of investors sort of taking leave of absence from the markets for the summer months. And this summer, there's a couple of things that's going on that actually could make it a little bit more volatile. Obviously, we've got the Olympics here in London. We've got the Euros as well, the football tournament taking place in Poland and the Ukraine. So that could even make volumes even lighter. Now, one of the attributes, or not necessarily an attribute, one of the factors of lower volumes, it can spike the markets one way or another. So if anything, we could see an increase in volatility. And then we're also looking at liquidity measures from the Bank of England, maybe even the ECB, although they're refraining to do that so far, and potentially also the FOMC. So there's a number of key factors out that could potentially be out over the next coming months that could actually turn the markets quite volatile as well.
Right now, Josh, we're also seeing a similar rout in the commodity markets. Would you say the decade-long commodity supercycle is drawing to a close?
Well, there are two issues here that's going on in the commodities market. One is liquidity, or in terms of quantitative easing, and the second element is obviously slowing global growth. Now, you know, you'd be a brave man to sort of bet against the recent sort of bull market in the commodity side of it, but certainly in the near term they're looking rather weak, and that's obviously a lot to do with slowing growth in China. We've seen them this week move to distance themselves from announcing similar stimulus measures they did quite a few years ago. That's not they haven't put to one side yet the idea of rate cuts though, so that could be one element that may help to support both commodities and commodity shares here listed in London or broader Europe. And then the other side of it also is quantitative easing. Bank of England have held fire on more QE for now. FOMC refusing to announce more QE, although the door is still open for that. So if we do see movements on that side of it, then that could also inflate asset prices such as commodities.
Now, Joshua, investors are fleeing to the safety of German and US Treasuries. Coupons on 2-year German bonds have in fact touched zero. Now, is this a clear sign of panic, as investors are only trying to protect capital at this stage and not looking at returns anymore? Also, what are the chances of yields going below zero?
I think there's a strong chance. I think it is a sign of panic, and I think it's a sign of where we are in the midst of, you know, the worst monthly fall here on the FTSE 100 for a year or so, and even if we do fall even more so today, I think the markets have bounced back. But if we enter negative territory, it could be even the worst fall since around 2008. So from that perspective, you know, it's no real surprise. And if you look at Spanish bond yields, you look at Italian bond yields, they're all edging higher and higher each day. It shows you that right now, particularly on a cyclical perspective where we're in the month of May, which is typically a bearish month, that most investors just want to try and put their capital into safer haven asset classes such as German bonds, UK gilts, US Treasuries, and sit on them for some time as long as they know that their capital is safe. And I think it's a sign of where we are in terms of the uncertainty in the market uncertainty of the Eurozone whilst we're waiting for that the next Greek election on the 17th of June.
Now, Joshua, there are some who argue that a Greek exit will bring the euro to parity against the US dollar. Would you agree to that?
I think right now we're looking at 119. I think that's looking like a strong potential move bearish. I mean, if you're looking at all the support levels are being broken at the moment, so 119 certainly looks at the instance. Now, if the Greece does exit, I mean, the one thing I would say is that most traders are kind of trading with the mindset that Greece will ultimately will have to leave the euro at some point, whether it's next month, whether it's 2 months, whether it's 1 year or 2 years. So I think the majority of traders out there are kind of expecting that to happen. You will always see an initial knee-jerk reaction, particularly in the euro, if that does happen. So certainly the knee-jerk reaction could be lower. But then again, it's all about what is the state of the eurozone after Greece. And when you take out a key drag away from the European Union, away from the euro rather, then there's always the potential to see some upside. So whilst the knee-jerk reaction could be lower in the longer term, it may not necessarily be bad for the euro.
Now, Josh, it's looking like Spain will ultimately need a bailout, but where's the money going to come from? Because Spain would need a substantial amount of money that would put a huge amount of strain on the 700 billion euro bailout fund, leaving little money for other emergencies.
Well, Spain's in almost like a perfect fiscal storm at the moment. On the one hand, they're trying to rein in their deficit to euro agreed levels, which the EU Commission said yesterday that they're willing to give Spain an extra year to meet that deficit target, because this year obviously they've already said that they're not going to be able to meet it. On the other hand, they've got high unemployment. 1 in 4 adults are unemployed. That's a huge number, and at the moment it's only rising. They've got a bank recapitalisation programme that needs to be announced and go through, because their banks, particularly you've seen obviously with Bankia, but some of the other banks have got exposures to toxic mortgage debt. And then at the same time, the ECB are refusing to move or to budge, and saying that now it's the role of governments to bail out banks, and they've already pretty much immediately poured a cold water on the plan to capitalise Bankia with Spanish debt and then exchange that through the ECB. So at the moment they're in a really difficult place.
Joshua Raymond, many thanks for coming in on the show and walking us through the outlook really for the financial markets in Europe and indeed the entire Eurozone. We'll slip into a very quick break then on Global Business Report, but when we come back, Iranian President Mahmoud Ahmadinejad tells a French news channel that he does not expect next month's talks with 6 world powers in Moscow to yield any major breakthroughs on the country's controversial nuclear program.
Samsung Galaxy S3. Designed for humans.
भाई ड्राइवर के हौसले से चलता है ट्रक।
अपन मारा इशारा पर चाले थे ट्रक 1 हो या 10 है, ठीक कौन करता है? और आप कौन है भाई साहब? अरे पहचाना नहीं? आपको जिताने के लिए तो जीते हैं हम। आपका साथ देती हैं हमारी ये मजबूत गाड़ियाँ, और आपके साथ चलता है हमारा बरसों का तजुर्बा। अशोक लेलैंड। जी हाँ, फिर तो ये हाँ, हम सबकी बनती है। आखिर देश भी तो हम सबके बल पर ही चलता है। अशोक लेलैंड, आपकी जीत हमारी जीत।
You're watching Global Business Report. Now, Iranian President Ahmadinejad believes that next month's talks with the 6 world powers on the country's controversial nuclear program is not going to bear much fruit. Deborah Luterbeck at Reuters brings us that story.
Iranian President Mahmoud Ahmadinejad tells France 24 that he does not expect next month's talks with 6 world powers in Moscow to yield any major breakthroughs on the country's controversial nuclear program.
We are not expecting miracles at the next nuclear meeting in Moscow.
Earlier this month, the 6 powers, the U.S., Russia, China, France, Britain, and Germany, failed to persuade Tehran to halt its most sensitive nuclear work. They will meet again in Moscow in June to try to end a standoff that has raised fears of more instability that could threaten global oil supplies. Iran's nuclear progress is closely watched by the West and Israel, as it could determine how long it could take Tehran to build an atomic bomb. Iran denies any plan to do this and says its aims are entirely peaceful. Deborah Luderbeck, Reuters.
Right, now, if you are a Tintin fan, then this is your chance to collect some rare memorabilia. An auction titled The World of Tintin's Creator will take place in Paris, featuring some rare first edition books, pictures, toys and even postcards. Tara Clary at Reuters brings us that story.